Hello everyone, thanks for joining the course. Today we had a big lecture on property plant and equipment, and in the evening we will do some homework thinking. We will go over morning materials pretty fast, and we will concentrate on several practical issues regarding PP&D. So let's begin. Let me know if you have any sound issues or quality issues or any other issues. Let me check my mobile phone. So everything seemed to be all right. Okay. And let me check my sound. Sound looks okay. So we can begin. So we started with lectures, MIT lectures on financial accounting. I'm sharing the link with you. MIT has 2 lectures related to PP&D, long-term assets and matching principle. In the first part, we reviewed the information related to capitalization of long-lived assets, why we need to capitalize those, and mostly we need to capitalize long-lived assets because we want to match the costs related to those assets to revenues generated by those assets, and that matching will happen over several years. So we cannot expense some of those assets right away. Most long-term assets cannot be expensed right away. And we didn't do much on book versus tax accounting because it's kind of complicated topic for us to look at right now. Capitalize versus expense. Capitalized costs means show it as an assets in the balance sheet. So it's debit PP&D credit cash, sorry. And expense is debit expense credit cash. So when do we have when do we have a choice to either capitalize or expense? And that's where property, plant and equipment guidance comes in, and it has pretty detailed description. So dependent on the type of your project and depending on the phase of your capital project, different accounts can be capitalized or expensed. The guidance has pretty good summary here, and so basically construction labor and other direct costs of construction, if it's a preliminary phase, then we expense, and the guidance also has the definitions for these phases, and you expense pretty much everything on the preliminary stage and you capitalize pretty much everything which is directly related to construction of the assets on a pre-acquisition and construction phase, and you expense pretty much everything which is like a overhead. Let's see, ground lease expense, what else, materials of supplies, capitalize, organizational costs, corporate bylaws, other agreements, all expense. So if it's an overhead, sorry, having some cold here, if it's an overhead, it should be expensed. Okay, so we did that. Does anyone have any questions related to capitalize versus expense? Maybe you have some example in mind. Please share. Okay. Assets are consumed in future to generate future revenues. Current assets like inventory, prepaid rent and insurance. Non-current assets like plant, buildings and machinery. So that consumption of the assets, of the long-term assets, of property, plant and equipment, it happens through depreciation. And we will see when how does depreciation work. Accounting for non-current assets. So we need to understand what is acquisition costs, and as you might remember from today's morning, acquisition costs will include not only price paid to the vendor of the equipment for equipment itself, it will also include the transportation to the intended place of usage and costs necessary to bring it into the operating ready condition. And that's all detailed in the standard. What is expected useful service life? That one will require your judgment. You will need to figure out for how long do you expect to use that assets. Usually companies have various policies in place when they buy and sell and use multiple similar pieces of equipment. They will have a policy regarding what's our expected useful life is. We had a Hertz example, which buys cars for $30,000, use them for 2 years, and resell them for $15,000. And in that case, your expected useful life is 2 years, and your salvage value is 15,000. What you expect to get for the car. And what pattern of depreciation should be used to allocate expenses over the useful life. So if you determine that your useful life is 10 years, you usually allocate that the expense from depreciation of that assets over 10 years. Most of the time you will deal with a straight line basis, but in certain situations, it can be production based. So basically, you divide your depreciable basis, which is acquisition cost minus salvage value. You divide that by 10 years, and then whatever you get, you divide that by 12 months, and then you recognize monthly your depreciation expense. And land is not depreciated. Acquisition costs. Purchase price plus cost to prepare the assets for use, installation, transport. Yeah, that self-construction assets. Direct costs of construction, financing costs. And if you want to get more details about that self-construction, you need to go to the guidance. We covered that today in the morning, so we will not redo that again, but you will find all the guidance here. Let's see if I can share the link. Yep. So here is the link to the guidance. Okay, let's go back to the lecture. Which one did I use? Okay, here. And we got examples. 92, 62,000, 10,000 maintenance. Maintenance is not capitalized routine maintenance. The general criteria for capitalization of expense is first one, if expense improves the assets, if it makes the assets better, you capitalize that expense. And second criteria, if your expense increases useful life of an asset, then you capitalize that expense. So basically 2 criteria. And to purchase assets, let's see. I did that example here. Equipment, payroll expense. Yeah, probably that one. So we debit equipment and we credit whatever we pay for different items. Sometimes we will recognize transportation and insurance as expense first, and then we will reclass it to the equipment. We will credit the expense and debit the equipment account. Okay. Self-constructed assets. So materials capitalized, architects and laborers direct costs capitalized, accrued interest payable. There is a complex calculation involved which we will review today, but generally it is capitalizable expense. You just need to calculate it properly. Fees related to zoning, inspection, etc. This will depend on the stage of the project. If we are not in preliminary stage, so we need to consult guidance about that. If we are not in preliminary stage, we will capitalize those. If we are in preliminary stage and we haven't decided on the project yet, but we incur these fees, we cannot capitalize them. Useful life estimated requires management judgment. Both salvage value and useful life will require management judgment. So this one is the time period over which you will use the assets, and this salvage value is the estimated proceeds at disposal. Depreciation method. What does GAAP allow? So we have production method and we have straight line. So straight line is clear. You divide it by amount of years you expect assets to be useful, and you divide it by 12 months and you expense it monthly. For production method, you figure out what is the driver for depreciation. If it is some equipment which you use, if it's some equipment which you use unevenly over its useful life, you kind of calculate how much hours of useful life you have left in that equipment. You allocate the cost of equipment to each hour, so you calculate basically how much will 1 hour of equipment will cost you to operate in terms of equipment cost. And then you calculate how many hours your piece of equipment worked in each reporting period and then depreciate. And here is a calculation. Let's take a quick look about which depreciation methods are discussed by accounting standard. Let's see, it should be here. The standard has a criteria for determination of useful life. And for many quite exotic situations in accounting, like defensive intangible assets, like when you buy a patent not to produce something based on that patent, but just for someone not be able to use that patent. So you just buy it and hold it, but you don't do anything with it. Salvage value and residual value. Let's see, do we have depreciation methods at all? Okay. So we have a principle here that we aim to distribute the cost of tangible assets less salvage, if any, over its estimated useful life in a systematic and rational manner. Several methods exist that allow us to achieve this objective, including the straight line method, accelerating method, and units of production method. And you have factors to consider to choose your depreciation method. Whether the asset is subject to rapid obsolescence, deterioration is a function of time or usage. Oops. So you basically have criteria to determine which method to use. Productivity decline with time, the cost of repairs and maintenance increases with time. And based on that, you might pick one: straight line, accelerated, or units of production method. Okay, here we have various calculation. I will skip them for now. And in the second part of the lecture, we reviewed where it is. We reviewed two situations. One was change in depreciation estimate, and if you change an estimate for your useful life or for your salvage value, you apply this change prospectively. So you apply it going forward since the moment when you determine that you have a change. And the other question was about disposals of fixed assets. So when you sell your fixed assets, a piece of property, plant, and equipment, you need to know what the cost of that asset was. You need to know what was accumulated depreciation of that asset, and you will need to know the proceeds you got for selling that assets. And knowing all of that, you can determine your gain or loss from disposal. Let's see if I have an example. Okay. So basically here we acquired the asset for 100 and then we modified it for $30. And when disposed, we wrote off the full cost, $130. And while the asset was in use, we incurred $40 and $55 of accumulated depreciation and 3 debit accumulated depreciation. So we basically removing whatever is on our books for that assets. We're removing that. Then we debit proceeds. In our case, that was cash. And then as a balancing number, we credit gain or loss for that asset. And when you have gain or loss from PP&D, you need to make sure you reflect it correctly in your cash flow. And cash flow was a previous topic. I won't discuss it much today. I will only say that if you have gain or loss on disposal of PP&D and you use indirect method cash flow, you will have that adjustment here. And you will also have proceeds from sale of equipment in your investing cash flows. Okay. Okay. So that was point 1 for today. Let me make a quick check on translation quality and on some materials. Okay. For some reason I was locked out from my accounts, so I need to reopen the documents. Let's see, do I have links here? Course folder. Excellent. Okay, so apart from review of today's lecture, I have PP&D in financial statements for today and capitalization criteria. We will look into that a bit more detail, and calculation of interest capitalized, and some information about homework. Okay, So here I want to open our homework, and I will make a copy. So we will work on homework 6 in like real time. Okay. So here we have review financials of 5 public which review PPE notes of. So you will need to select 5 publicly traded companies which you think are heavy on property, plant and equipment. And let's take a look. I've already got 2 of those open. One was Apple, but Apple is not really heavy on PP&D. They only have what do they have? 40 billion of PP&D, while their total assets are 40 billion. So their PP&D is only like 10%. Let's see if they say anything about their PP&D in their financials. Intellectual property. So they are probably heavy on intangible assets. Let's better try plant. Okay, Apple has a short note here about property, plant and equipment, and we discuss that's an excerpt from summary of significant accounting policies. So we can probably, if you want, you can summarize it somewhere. But I won't do that now. So first of all, we have PP&D in accounting policies, and we discuss what are the useful lives, 1 and 5 years for machinery and equipment, including product tooling, manufacturing process equipment, and the shorter of lease term or useful life for leasehold improvements. Capitalized costs for related to internal use software are amortized on a straight line basis over the estimated useful life. Non-cash investing activities resulted in a net decrease to accounts payable and other current liabilities of 2.9 billion. Okay. What else do we have for property, plant and equipment? Okay, we have a breakdown. We have a breakdown by types of assets: land and buildings, machinery, equipment and internal use software, leasehold improvements, gross property, plant and equipment, accumulated amortization. Let's see. And we have some information about finance leases in leases section. Not much information, I would say. Let's see what we have in accounting guidance. Do we have anything about disclosure requirements? Let's try to find out. So it looks like now that disclosure, there is no centralized disclosure piece in that guidance. It has disclosure requirements for some situations and not much than that. Let's see if we have anything about property, plant and equipment uh, in our financial statements preparation guide. Okay, we have some pieces of information related to disclosure requirements, in particular for publicly traded companies. SAC requires the amount of accumulated depreciation, depletion, and amortization of PP&D and equipment to be presented separately in the balance sheet or in a note. Assets recorded under capital leases may be combined with owned assets and are often included in property, plant, and equipment line item. Leases codified capital leases will be called finance leases and will be separately presented as a right of use assets. Okay, let's see if we have that anywhere else. FSP 8. So let's see what is FSP 8. Okay, we will find it here. So this is cash flow. We are looking for chapter 8. So this still relates to the cash flow statements. Contribution. Other assets. Long lived assets. ASC 360 provides the general disclosure requirements for property, plant, and equipment. Because of the significant effects on financial position and results of operation of the depreciation method or methods used, all of the following disclosures shall be made in the financial statements or in notes. Depreciation expense for the period, balances of major classes of depreciable assets by nature or function at the balance sheet date, accumulated depreciation either by major classes of depreciable assets or in total at the balance sheet date, a general description of the methods or methods used in computing depreciation with respect to major classes of depreciable assets. And some entities may comply with this requirement by presenting the amount on the statement of cash flows. So there is actually not a lot of disclosure requirements for PP&D. And if we take a look at Apple, so first one, depreciation expense for the period. Let's see, do we list it here? It's not here, but let's go to, so it's page 49. Let's go to our financials, financial statements. Do we have depreciation in the income statement separately? No. Do we have depreciation in cash flow statement? Yes. So Apple disclosed its depreciation in the cash flow statement, and we can tick mark. Let's see. we can say that it's done for Apple. Balances of major classes of depreciable assets by nature of function at the balance sheet date. Okay, that was page 49, I believe. No? Here. Okay, here, page 43. So here we have it. Major assets by, I think that's by classes. So each disclosed lands and building, machinery and equipment, leasehold improvements. So that one is done for Apple. Accumulated depreciation by classes or in total at the balance sheet date. It's here. Depreciation is here. So Apple does everything right. A general description of the method or methods used in computing depreciation with respect to major classes of depreciable assets. Let's see if we have it in policy. Not much of the mentions of depreciation. Depreciation on property, plant and equipment is recognized on straight line basis over the estimated useful life of the assets, which for buildings is 40 years and so on. So Apple did great here too. As you can see, disclosure requirements. You can also note that there is a requirement to present any assets mortgaged, pledged, or otherwise subject to lien, and that is not ASC requirement. That is State Securities and Exchange Commission requirement. Let me take a look. And I don't think Apple has much assets mortgaged, but I think AMC has a lot of assets mortgaged. Let me see, December 31st, 2020, financial statements. So let's do the same exercise for AMC. Income statement, balance sheet, property net 2 million, operating in leases separately, 2 billion, operating leases 4 billion, stated separately. Depreciation in the cash flow statement. So we can go back here and do one more tick mark for AMC. Major classes of depreciation assets. Let's see how we can find it. Land. Do they call it plant at all? No. Property. 48 mentions. Okay, property. We are looking for breakdown of property by classes and accumulating depreciation. Fixed operating leases. Property, finally. So as you can see, it looks almost the same as IMC. With only exceptions, there is a property lease under finance leases. And we have accumulated depreciation here as well. So we've done that. We've done accumulated depreciation. And let's see if there is a method describing the depreciation. For some reason. Okay. Okay, 42 mentions of depreciation. The company uses a straight line method in computing depreciation and amortization for financial reporting purposes. So we can put tick mark for that. And let's see if we can find information of any assets mortgaged, pledged, or otherwise subject to line and the obligations collateralized. So we do not have any mentions of the mortgage. We have mentioned that all assets located in England and Wales have been pledged as collateral. We have pledges of capital stock of the certain company subsidiaries and pledge of equity interest. Okay, and we have like a billion of mentions of lion, because one of the loans of IMC has lion in its name. Let's see if we have collateral. Okay, we have pretty much a lot information about collateral. Okay, we do not actually have much information about pledged assets at AMC, so we don't know if they disclosed much. They disclosed some pledges and collaterals, but they were not very specific about that. So we can probably give them a tick mark on that matter. Now let's see what we have in the plan today. Capitalization criteria. It's a repetition of what we did in the morning, but it's still pretty important. So first of all, let's go to homework 6. We did 2 reviews of public companies. Others you can do yourself. Let me okay. Let me make a photo. Okay, let me cancel that. I will make an excerpt of that information and just put it in the homework. Okay, let's call it number 2 then. Okay, number 1. List and learn. Capitalization. How to framework. Okay, so let's say what do we have? What do we have at A? We need to determine the stage of the product. And the stage might be preliminary. Let me open the standard here. Preliminary, pre-acquisition, construction, in service. Preliminary, construction, in service. B. Okay, if preliminary expense almost 100% okay, I don't like that formatting. So if we are in a preliminary stage of the project, and most of the time we expense everything, but there might be some exceptions in the standard related to that. If pre-acquisition and or construction if directly related to the asset, capitalize. See examples in the guidance. If overheads including interest, that's important. Interest is important. If overheads expense, and let's be very cautious and say mostly capitalize, mostly expense, and we need to see examples in the guidance. And finally, D, if in service okay, so here we say if improves an asset more production or efficiency, capitalize. If increases useful life of asset, capitalize. If neither, expense. Okay, let's do page break. I will remove that one. I'll move to here, and I'll move my PPE here. So that framework may deal with most of your headache related to PPE capitalization. but you will have to look into guidance regarding various kinds of expenses. You want to make your list, but whatever is directly related. If your worker works on that project, it's direct expense. If your equipment works on that project and you have a depreciation expense, it's a direct expense, and so on. Okay, let's check with the schedule whatever we have left. Interest capitalized calculation, and that will be our third point for the homework. Interest and let's do it this way. Okay. Let's go to our guidance and let's go to interest capitalized. Let's see where it is. Okay. We have a bit of a creative task here. So explain in your own words. Oops. And we will work on that calculation. I'm sorry, I shouldn't probably do that near the microphone, but I'm a bit of lazy and it's 10, almost 10:30 p.m. So our interest capitalization calculation will be based on the example in the guidance, and you can either use the approach in the guidance, uh, assuming you know what you are doing, assuming you understand what they do. Here. Okay. I have a second piece. Okay, and they already calculated your capitalization rate. And today I will do an alternative approach to that, and I'll probably do it in the same file. No, I will do it in PPE file. At least I did some PPE file. Okay, let's call it capitalize. Okay, and I'll have to copy my homework information here. Okay. So what do we have here? We have these cash flows. Monthly flow, accumulated flow, 100,000, 400,000, and again 400, and again. And accumulated will be here, 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 here. And that was year, let's call it year 1. Okay. So our approach would be first calculate applicable capitalization rate, which in our case will be for 71%. It's already calculated above. Second, apply the rate to applicable balances. And I'm doing it a bit differently from the guidance, but the result will be the same. I depending on which method for you is easier to understand, you may use any result. So time left to year end months. And again, I will also assume a half month convention, that these cash flows happened in the middle of the month. So we have 3.5 here. We have what do we have? 2.5 here. We have 1.5 here. And we have 0.5 here. Then I will calculate monthly interest rate for 71%, and monthly interest will be just for 71 divided by 12. And let me just make it format this as an interest, so it's pretty small. What? Sorry. So I calculated the monthly interest rate. So what I'm trying to say here is that that balance stayed with us for let's see if I'm not making a mistake here, because half month convention, it's actually not doesn't make me any favor here. So that value, we got it in the September 15 and it increased in October 15. So basically I can take that for 1 month. Then I have this one for 1 month as well. Then I have this balance for 1 month as well. And that balance, the highest balance is December, it kept for half a month. So I basically take this balance and I take only half of the number. So let's see if I were right. $8,438. Yep, $8,439. Basically, yeah. So the approaches are the same. Surprise, surprise, but it's just simple math. So I don't need that data. I just need to. So if I use half month convention, I use that one for half a month. So that's assumed that it is starting September 15th. No, that's probably a bad place to write it. Let's make it here. September 15, October 15. October 16, November 15. November 16, December 15. December 15, December 31st. Okay, now it should be more or less clear. Time when accumulated balance is relevant. So the more our accumulated balance of construction in progress, the higher the accumulated balance of our construction in progress gets, the more interest expense per period we have to capitalize. Okay, so that should be clear. And the total result is the same, but for me it's more clear to use accumulated balance of construction in progress. So at this stage, when we spent only 100K, it means that we kind of borrowed 100K, or we didn't pay off 100K. We could have used that cash to pay off 100K of debt, and we would have saved that amount of money. And here on December 15th, we already have 1.3 million invested. That means that our borrowings are 1.3 million higher than if they would have been if we used the cash to pay off the borrowings. And that means that we need to apply that monthly rate to that balance. But we only apply it to the half because we use a mid-month convention. We can calculate it even without, let's call it with mid-month convention. Without mid-month convention. And that would be, so we simply just multiply everything again. And that way our calculation is kind of higher, because we just assumed like we did the investment on the first of the month. And we can, no, I will not do that. It's already 1 hour, and I do not plan to stay here anymore. Thanks anyone for joining. Let's see. Hopefully we have someone today, and let's meet on Wednesday. Hopefully you will get any questions by that time. For today, thank you and have a great rest of your weekend.